Hi, and welcome to Dollars and Making Sense, a weekly show about finance, money, and investing. I'm your host, Ray Treverson from OTG Capital. We broadcast locally on Radio Northern Beaches and around Australia on the Community Radio Network. I'm always very pleased to welcome back to the microphone and the TV screen Natasha Panagis from the Institute of Financial Professionals of Australia. Natasha, welcome back.
Ray, thanks for having me back on.
Now, for those of you that may not be aware, Natasha is a subject matter expert on superannuation. Natasha, over the years that I've got to know you, you do a lot of regulatory work. You do a lot of submissions on behalf of IFPA into the government around superannuation policy. I know you and I have spoken on many interviews around superannuation and some of the policy shifts that are still being tinkered with, and we all get frustrated because super is one of those tinkering things, isn't it?
It definitely is. It always has been. It's almost like we dip into super to fund some, budget deficits. So, certainly a lot of our advocacy efforts over the years have been to stop tinkering with it. And if we do need to make changes, then let's just do a holistic review to see what's working and what's not.
Absolutely. Now, I had your colleague Stuart Sheary on the show, and we were talking about accessing super, but on special occasions for hardship and compassionate reasons. And so with Stuart, they're explaining some of the very specific reasons about why you can access. I think it was a really good show in that regard. And today we're talking about access to super in a different way, because we're going to be talking about life insurance. But one of the key takeaways, Natasha, that I'd like to remind the audience about that we talked with Stuart about was that the two $10,000 drawdowns that happened during COVID, it's now been estimated that drawdown, depending on how old you are, could impact some retirees upwards of $90,000 impact. That number scares me when you think about, I take 10 here and 10 there, but at the end of the rainbow, all of a sudden you're $90,000 less well off than you potentially should have been. So I think, from Stuart's show, and because we're going to be talking about life insurance within super today, this is one of the elements where it's a good thing, but we've also got to be mindful of some of that impact. But we've got 4 shows we're actually doing on this because, ladies and gents, Natasha explained to me there's a lot to cover, isn't there?
There is, and you can't do it in one show. Well, I think we'll divvy it out into 4. Focus today on life insurance, and then we'll do one on disability, total disability, and then we'll do one on terminal illness and also income protection. So yes, let's go through them and put them into different chunks and see where we go.
Okay, so TPD, if people aren't aware, TPD stands for total or permanent disability. And so that is part of the cover that you can potentially get from your superannuation fund. So let's dive in. So as we say, we're going to be covering this in 4 shows. And one of the things that people should be aware of, these shows will probably flow into a lot of April. And we've got a big show coming up down in Melbourne on the 4th of April, which OTG Capital will be participating in. But I know, Natasha, you've got a lot to impart during that one-day conference. You guys really jam it in one day.
Yeah, look, probably could be done over 2, but we do have our IFPA National Conference in April. It's shaping up to be a great event for professionals in the tax, super and financial services space. Right. So if you've got practitioners listening today, then, if you're looking to sharpen your knowledge and you've got time to get to Melbourne on the 4th of April, well worth coming along to see what you can learn and get some practical strategies to help your clients.
And we'll be doing some shows as well, and we'll be obviously there talking about what we do, but that's another story. So today we're focusing on tax and accessing the benefit of a life policy within super. So first of all, let's cover off, when you're going to do this, who are the trustees of a super fund?
Good question. So if you hold life insurance in your super fund, the payout is going to go straight to the trustee of your super fund, because it's the trustee that owns the policy, not you. And so if you're part of a large industry or retail super fund that's regulated by APRA, then the trustee of that fund will control the payout. But if you have your own self-managed super fund or SMSF, then that trustee is more than likely going to be you. and that means you will have that control about how that money is handled. So when an insurable event happens, and today we're talking about life insurance. So if a member passes away, then that payout will be added to their super balance, and then it'll be distributed as part of the super death benefit. And then who it goes to will depend on your fund's rules and any beneficiary nominations in place. So it could go to a particular person, or it could go to your legal personal representative, in other words, your estate. And it all, as I said, depends on what nomination you have in place and what the super fund rules are.
Now, I think it's really clear I think it's a really important fact that we should let people know that the nomination that occurs within a life policy in super is very, very different to a last will and testament, isn't it?
Yes, definitely. Super doesn't automatically just go to your estate. It isn't covered by your estate or by your will. It only is if you direct it to your legal personal representative. So that's one thing that people often fail to consider or don't realise. It doesn't get captured as all your other individual assets do. So it can be guided. It is guided by any nomination forms that you may fill out within your fund.
So let's talk about that, the BDBN. What does the BDBN stand for?
Yeah, so it's a binding death benefit nomination. And as the term suggests, binding means it binds the trustee to pay your super to one of your dependents. And obviously, they do need to be a superannuation dependent to be able to receive that benefit directly from your fund. Again, another misconception is that, people think that they can nominate anybody on their nomination form for their super, but not everyone can get a benefit directly from your super fund because the law distinguishes between a super dependent and a tax dependent. And the differences really matter when it comes down to tax purposes.
And that's actually my next question. So the idea of life insurance is to pay a benefit if someone dies, but in this case, the beneficiary has to be quite specific. So can we just highlight what that difference between a tax dependent and a super dependent is again?
Of course. So a super dependent is someone who can, as I said, receive your benefit directly from your fund. And this includes people like your spouse, your children of any age, or anyone who is in an interdependency relationship with you or in a financial dependency relationship with you. So that's a super dependent. Whereas a tax dependent is someone who qualifies for a tax-free treatment of that benefit that they receive. Now, the difference here is although your spouse and your minor children are considered tax dependents, as well as financial and interdependent people, the key difference here for tax purposes is that it does not include an adult child who is financially independent. And also, so that's the key difference. It doesn't include an adult child when we're talking about dependent from a tax perspective. That's one of the key differences. And also the other difference is a former spouse. For superannuation law purposes, a former spouse is not considered to be a dependent, whereas for tax purposes, they are, and they could receive it. But if they want to receive it, then they need to get it via your will, not directly from your super fund. So yes, although any child of any age can get it directly from super, there's going to be tax differences between a minor child and an adult child.
So before we get into the specifics about the tax differences, you mentioned ex-spouses. Now, one of the real problems that we face as professionals, and you've seen this and I've certainly seen it as well, even though I'm not a financial planner or a tax agent, I know when people forget about BDBNs, the binding death benefit notices, especially once they separate and divorce. I've seen many cases happen in my own extended family where that didn't get changed and the former spouse was still on the policy. What kind of headaches does this give the poor old super fund?
Yeah, look, it does become complex. I mean, if it hasn't changed, then, at the time of death, they'll need to then have a look at, well, who has been nominated? Are they still a valid beneficiary, because they need to go through this painstaking process to work out, right, has the person who has been nominated still a valid beneficiary? Now, if they are a former spouse, then technically it's not a valid nomination, because a former spouse cannot receive the benefit directly from the super fund. So then the super fund's going to need to work out, well, who else is there out there, and then reach out to potential beneficiaries to see if they want to make a claim. So, it can open up a can of worms. So if there's ever any changes,
it doesn't stop them from claiming, though, does it? I mean,
of course not.
They see their name there, and all of a sudden they're going, "Hang on, I've got," and they will then put their hand up and say, "Please give me."
Anybody, yeah. Look, anybody could do that, right? And if we're talking about a former spouse here, if they had some evidence or some proof to show that they were still financially dependent on their deceased ex-spouse, or they were in some type of interdependency relationship with them, then maybe they could get it under one of those two definitions. And it could also include other beneficiaries as well, like other adult kids, maybe from a previous marriage. So the key thing here is to just make sure, if there has been a change to your circumstances, keep your death benefit nominations up to date. Keep them relevant, and some of them generally may expire within 3 years. So if it's coming up to expiry, look to renew it. Some of them are non-lapsing, which means they could continue indefinitely, which is a good thing. But at the same time, if you've got changes happening to your situation, then that's when you'd want to go back and make sure that they're still relevant for your circumstances.
So, look, I'm going to come back to this. We're just about half time. You're here on Dollars and Making Sense, a weekly show about finance, money and investing. I'm your host, Ray Treverson. At the microphone today, I have Natasha Panagis, a superannuation expert from the Institute of Financial Professionals. We're going to take a short break, and we'll be back with you in just a moment. Hi, and thank you for listening to Dollars and Making Sense, a weekly radio program about finance, money and investing on Radio Northern Beaches and nationally on the Community Radio Network around Australia. The views, comments and opinions aired during our program should not be construed or viewed as financial advice. Any commentary is general advice only and does not take into account your objectives, financial situation or needs. You should consider whether the advice is suitable for you and your personal circumstances. If in doubt, you should contact an authorised licensed financial planner. We welcome questions and feedback, and you can get in touch with us via our blog, social media channels or email. Please search for Dollars and Making Sense in your favourite podcast platform, or check out our blog at otgcapital.com.au/blog. Hi, and welcome back to Dollars and Making Sense, a weekly show about finance, money and investing. I'm your host, Ray Treverson, and with me today is Natasha Panagis from the Institute of Financial Professionals, and we are talking today about life insurance within superannuation. Now, before we went to the break, Natasha, we were talking about the potential beneficiaries, and particularly when we've got blended families and divorces and separations and the like. I guess one of the things I was thinking, just as we were in the break, when within super, a life policy, this link of dependency has to be well established, even if a binding notice is lapsed or is inappropriate. Let's say the couple divorced, and it's not, this ex-spouse is no longer a dependency. Within super, I think there's a clear element that says that's not valid. But if it was outside of super, let's just say it was a standard life insurance policy and they forgot to change the beneficiary, it would be reasonably clear cut then, wouldn't it, that that policy then goes to that person regardless of the circumstance change?
Yeah, look, if you've got the policy in your own name, and you're the life insured, then it will get paid to you, as or to your estate. It just depends on who the beneficiary of that policy is outside of super. So you can nominate someone, or it can go to your estate. And if it goes to your estate, then your will can stipulate who that benefit can be paid to. So it can become clear. It is easier, I suppose, outside of super, and there's less tax consequences if it's outside of super. Whereas if it's inside super, it really comes down to, well, it's going to form part of your member benefit, and there's only certain people that can get your super death benefit, and you must be a super dependent in order to get a super death benefit from the member. So as I mentioned before we went to the break, that is someone like your spouse, a minor child, a financial dependent, or an interdependent. Only those 4 people can receive a superannuation death benefit that includes insurance directly from the fund. And if you're not one of those people, then it must go to your estate. And then if you want to benefit someone else, then your will must state who that person is.
Okay, so I guess one of the clear elements then that when we're talking about tax, and listeners and viewers need to understand, the reason that the tax needs to be considered is because it's within a tax haven in of itself, isn't it? Because superannuation is treated from a tax perspective very differently to our income and our expenses outside of super. So that's the reason we've got these tax laws that prevail within the super environment, isn't it?
Yeah, that's right. Super is a tax concessional environment, as you say, Ray. Inside super, the most you'll pay tax on any earnings and contributions is up to 15%, whereas if you're in pension phase, that's a 0% tax rate. So it is concessional, and for that reason, there are limits on who can receive your benefits and the like.
Okay, so let's talk about the tax implications, because before we went to the break, we were talking about the difference between dependent children and adult children. So let's pass those two apart right now. So if somebody passes away and there is a life policy there and there are dependent children, what's the situation there for tax for those dependent kids?
Sure. So say you pass away, and you obviously those proceeds get paid into your member account, then what happens from there is you have a choice in terms of how to receive, not you, because you're obviously passed away, but your dependents have a choice in terms of how they may want to receive those benefits. So
Yes.
the first way is a lump sum. They can take the entire amount or an amount out as a lump sum. They could start a pension, or they can do a combination of both. So if we break it down and maybe just look at what happens if you were to take a super death benefit lump sum from super, if you're a tax dependent, so in other words, if you're a spouse or if you're a minor child, then you're considered not only a super dependent, but also a tax dependent, which means you'll get the full amount as a lump sum tax-free, which is wonderful. But if you are not a tax dependent, like if you're not a super dependent, so in other words, if you are an adult, independent, financially independent child, then and you'll want to take a lump sum, then you may pay tax, and you can pay anywhere between say 15% and 30% on any taxable component that forms part of that death benefit. So adult children receiving a lump sum death benefit can pay anything from 15% to 30% on any taxable component. Medicare levy will apply on top of that if they're receiving it from super, but if it goes to the adult child via the estate, so for example, the death benefit is paid to the estate and the adult child takes that benefit from the estate, then they can save that 2% Medicare levy. I know you're probably thinking, well, what's 2%? But sometimes 2% on a couple of $100,000 can make a difference.
Yeah,
so that's one little strategy, I suppose, for adult kids who may be benefiting from a super and life death benefit payment. So that's the lump sum side.
Mm-hmm.
If we're talking about pensions and the beneficiary wants to start a pension, so in this case, let's just call it a spouse. Look, a minor child could also receive a death benefit income stream, but I've got to say, in all my time, I've rarely seen a child receive a death benefit pension. In 99.9% of the cases, it's usually a spouse that will commence a death benefit pension. In this case, it's going to come down to the age of the deceased and also the age of the beneficiary. At a real simple level, if the deceased was over the age of 60, then the beneficiary will receive those pension payments tax-free. But if the deceased was under 60, then it will depend. Some tax may be payable. It will come down to the age of the beneficiary as well.
So I'm curious then, by the sounds of things, it sounds like as you age through your 30s and 40s, from a pure financial perspective, it makes a lot of sense to have life insurance cover within super because it's a hidden cost. You don't see it, and you've got other things that are more important. You're paying off a mortgage, college fees, educating your kids, etc. But once they get to adult age, it certainly sounds like a very viable strategy is then eventually to take those policies outside of super so that the beneficiaries, should the unfortunate happen, actually is then payable without the kind of tax implications within super. Is that a fair statement to make?
Yeah, I agree. Look, if you don't have any kids, then it doesn't matter. It's probably worthwhile considering keeping it within super. If you've got a spouse and your spouse is going to benefit and that's all you've got, then that's fine. Having it inside super won't mean any adverse tax implications, generally speaking. But if you've got adult kids and you want them to benefit from your super death benefit and any life insurance you have as well, then it's probably worthwhile considering having it outside of super, because outside of super means no tax on payout for adult kids. Whereas if they were benefiting from it within super, then there's going to be tax implications for them. So it really comes down to who your beneficiary is going to be. If it's just the spouse, then it doesn't matter whether you have it inside or outside. But if it's adult kids, then really worthwhile thinking about pulling it out and having it outside of super.
I know, and again, I've gone through these kind of discussions with my own family. You get to a certain age and you look at the cost of life insurance policies, particularly once you get past 55. It starts getting fairly prohibitive. And so I think some of those decisions are made well and truly on behalf of the life cover companies. When they forward you the premium, you look at that and go, oh, maybe we won't be doing that this particular time around. Anyway, let's keep moving on. When we're talking about these particular policies then within super, are there tax deductions allowable for the policy premiums along the way?
Yes, definitely. Premiums are tax deductible to the super fund, particularly if we're talking about life insurance. So the cost of those premiums are deductible by the fund. And if you run your own SMSF, that applies to you as well. So you can certainly get a 100% tax deduction on those life insurance premiums paid.
Now, looking at the notes that you've sent through to me previously, and I like to be well read on this stuff so that I actually sound like I know what I'm kind of talking about, especially compared to you, Natasha. But I see that there are a lot of tables with regards to tax and super benefits. Just as a handy resource, where can readers, listeners and viewers go and find these tax tables? Is this something that's at the ATO, or is it within an easy to get sort of resource?
Yeah, so I read these articles for our bi-monthly magazine. It's called Outlook magazine, and we issue that every 2 months. So every edition I've released each part. So the first one was about life insurance. So it's available in our Outlook magazine. But look, there's also information available on the ATO website. If you really had a good search in there, it does explain the tax implications.
Okay.
But certainly the Outlook magazine is available and you can find it on the IFPA website, which is ifpa.com.au.
So let's talk very quickly just to round out today's show, because this is part one of a 4-part series, ladies and gents. You talk about an alternative option, the future service deduction. What does that mean?
So in most cases, or if not all cases, when super funds hold a life insurance policy on behalf of their members, they will generally just claim that premium as a tax deduction for the fund. So that's your most common scenario. But there's an alternative option for claiming a deduction. This is called the future service deduction. And what this comes down to is it all depends on the future portion. It's based on the period of time that a member could have worked if they got to age 65 had they not passed away or become disabled. So
Right.
this future period of time, age 65 is that special age that's written into the legislation, and the deduction effectively represents this future period of time that you could have worked to 65
Right.
if something hadn't happened to you. So although this deduction is available to all super funds, typically only SMSFs will use it. And it doesn't matter if your fund has claimed a tax deduction in previous years for the premium. It all depends on what choice you make for deduction purposes in the year that a benefit is paid out. So it can be quite a powerful strategy because it can significantly reduce your tax bill. For example, to give you a really quick example, there was a client who had who was 50 years old, passed away. He had $1 million in life and total and permanent disability insurance in his fund. In the year of his death, the advisor looked at it and provided some advice to the surviving spouse and said, well, if you didn't claim the $2,000 premium deduction, you could instead choose this future service deduction. And by doing the calculation for this future service deduction, it worked out to be a $750,000 tax deduction for the fund. So that wiped out all the tax assessable income and tax in the year for that SMSF. And because it's such a large deduction, can continue to carry that forward and use that to reduce the fund's taxable income in future years. Now, of course, it will depend. It's going to depend on your super balance, on your life insurance, your age and all of those things. So generally speaking, the younger you die, the bigger the deduction for the fund, whereas the closer you are to the age 60 or 65, the smaller the future service deduction. So it's worthwhile, if this happens, just to maybe seek some advice, and particularly if you have an SMSF, to work out, should we claim a deduction for the premiums for that year, or should we go for this other option called the future service deduction?
Okay, that's a really good takeaway, I think, ladies and gents, to remember. So it's in the year that you make the claim that I guess is of the most pertinent. So hopefully, if you are getting good advice, that will be something mentioned to you. But certainly, it's a great takeaway. So look, we're just about at the end of today's show. Wow, that time just goes so fast. But as I say, this is part one of a 4-part series. There is a lot to cover in this space. So Natasha Panagis, until next time, thank you for being on Dollars and Making Sense. And we're going to keep talking about life insurance within super. Thank you.
Right.